Hello and welcome back to the Canadian Money Roadmap Podcast. I'm your host, Evan Neufeld. Today I'm joined by special guest Mark McGrath, who's a fellow CFP and an expert on all things corporations. In this episode, we cover off a number of things, but we talk about whether it's beneficial to be incorporated if you're a small business owner, if you're a professional like a doctor, but also some of the pitfalls that come along with that, including investing in a corporation and what really is a write-off. So without further ado, here is my interview and conversation with Mark McGrath. All right, joining me today is Mark McGrath, and Mark is a wealth advisor at Wellington-Altus Private Wealth, based out of Squamish, BC. Mark is a certified financial planner, chartered investment manager, chartered life underwriter. What else, Mark? Did I get all the letters there?
Yeah, just those three.
Yeah, okay, perfect. Mark primarily works with high-income professionals and is an expert on our topic today, financial planning for incorporated small business owners. Mark, thanks so much for joining me.
Yeah, thanks, Evan. No, it's a pleasure to be here. I'm excited to chat with you. Thanks.
Okay, so when we talk about corporations, for the sake of this episode, I just want to make it clear at the beginning that we're not talking about Shell Oil and TD Bank and McDonald's, but this is a structure that you could have for yourself, for your own business. So for myself, I have a corporation, and I know many doctors, like folks that you work with, they would have corporations too. So maybe could you give me a little bit of a breakdown of what is a corporation and maybe who would be a good candidate for incorporating and what are some of those benefits? That's a lot of questions to get started, but I'll let you run with it.
Sure. Yeah, no, sounds good. Yeah, so the concept of a corporation has been around for hundreds and hundreds of years, actually. Corporations are effectively a distinct legal and tax entity, right? So if you think of a lot of small business owners, they operate under a different model called the sole proprietorship, right? And what that means is they effectively are the business. So all of their income, all of their expenses, it all goes on their own kind of personal tax return. But you can separate the business from the individual through the corporation, right? So again, it's a distinct tax and legal entity. The corporation itself is just a structure, right? The structure is really controlled by the shareholders of the corporation, right? So for your company, for example, you've got your corporation, you're effectively the primary shareholder, maybe the only shareholder, and you have control over that corporation. There's two major benefits, I would say, to incorporating your business. One comes down to liability protection. And so I'll give you an example. A very close friend of mine operates a company out here in BC, and it's a small boat tour company called Quadra Island Boat Tours. And for him, he's out on the boat. He's the boat captain. He's taking people from all over the world out on a boat for 4 to 6 hours a day, right? There's a lot of risk there if somebody falls off and can't swim, if somebody gets hurt, if weather becomes an issue, right? So regardless of how successful the business is, that liability protection means that if something were to happen, it's the business that's being sued. It's not him personally. So if something happens, they sue his company, but his home, his personal assets, his personal investment portfolios, they're not available to any creditors. So the liability protection in and of itself can be a huge benefit to a lot of business owners. And really the second major category of benefits has to do with taxation, and primarily in the form of tax deferral. So as an example, let's say you and I start a company, we start a pizzeria, let's say, right? And it's incredibly successful and we make a lot of money. Let's just assume for the sake of the example, we have $1 million in profits in the first year, right? Well, that's $500,000 each. But if I don't need $500,000 today to meet all of my obligations, my living expenses, my mortgage, my groceries, that type of thing, that's unfortunate because I'd have to pay tax on $500,000 of income when I don't need the majority of that income until later on. But if we earn that income through a corporation, we can pay ourselves a salary that's sufficient to meet our family's needs, and we can leave the rest of those profits inside the company. And we can defer tax on those profits into the future. We can take out that money later on, like in retirement, when we might actually need that income to support ourselves, right? So because of the tax differences between individuals and corporations, and we can get into some of those numbers, tax deferral, pushing that income into the future, is one of the other major benefits. There's other tax benefits too, like if you have an active business that you might be able to sell in the future. Canada allows certain small businesses that qualify, if they sell the shares of that company, some of the capital gains, some of the growth of that company can be exempted from tax. That's known as the lifetime capital gains exemption. We can chat about that as well. So primarily there's the two big camps, I would say, liability protection and tax benefits.
let's spend a little bit more time on those tax benefits. And so I think there's a lot of misconceptions about corporations and how they work. And there's a lot of boogeyman philosophy around corporations of like, oh, the corporations need to pay their fair share of taxes. And we were talking about like, yeah, corporations can actually pay less taxes. So maybe dovetail that into the idea of integration a little bit and how corporations and people can work together, but yet they are still separate as far as tax is concerned, and how CRA gets their share from corporations.
Sure. Yeah. And you nailed it. The concept is called integration, right? And integration is CRA's mechanism by which, whether you're incorporated or not, or regardless of how you might earn your income, you're more or less going to pay the same amount of tax by the time those dollars hit your back pocket, right? So again, there's tax advantages to the corporation, but corporations and individuals, their shareholders, when looked at in unison, are going to be paying a total tax that is similar, whether you're incorporated or you operate under a sole proprietorship or you're an employee of a company, right? So the way that taxes work for small businesses in Canada, and the tax rates are provincial. So if I'm giving examples, I'm going to be talking about BC tax rates. There are differences across different provinces, but the general concepts are effectively the same. When the corporation earns an income, the first $500,000 of income that a corporation earns is subject to a very low tax rate. And that $500,000 threshold is something called the small business deduction. And there's things that can impact that threshold, but that first 500,000, generally speaking, is taxed at a very low tax rate. In BC, that rate is 11%. So the combined federal and provincial tax on the first $500,000 is 11%. If you earned $500,000 personally, your top tax bracket in BC is 53.5%. Again, they're marginal rates, right? So you're not paying 53.5% on every dollar, but you might pay, 40, 45% overall tax on that first 500,000. So you earn 500 grand, you pay 11%. That's $55,000 in taxes on that amount. Money or income rather over 500,000 is taxed at what's known as the general rate. The general rate in BC is 27%. So that $501,000 and every dollar above that is taxed at 27%. Now, the distinction between those two levels of income is important because when you pay yourself dividends out of a corporation, you can pay yourself one of two forms of dividends. One is a non-eligible dividend or an ineligible dividend, and the other is an eligible dividend. And the distinction is important because when you pay tax personally on those dividends, which type of dividend it is determines how much tax you're going to pay. And again, there's another complex mechanism at play here known as the dividend gross up and the dividend tax credit. So it's all very complicated, but by the time either of those dollars hits your back pocket, from the source, it will have effectively been taxed the same way, right? So eligible dividends, because they've been taxed at the higher general rate, are taxed lower in your hands versus ineligible dividends, which were taxed at a much lower rate in the corporation and are taxed a little bit higher in your hands.
Right. So it all depends on how much money your corporation is making. And depending on how much your corporation is making, that determines whether your corporation is going to pay a higher rate or you're going to pay a higher rate, kind of, right? And,
some degree, yeah.
Yeah, just at a very simple level there. So now when we talk about taxes within a corporate structure, most businesses, some will have very low expenses, but some will have lots of expenses. Talk to me about the idea of a write-off. Have you heard that term before? Mark, before you maybe get into that, between these two shows, would you be a fan of Schitt's Creek or Seinfeld?
I
Neither?
Interestingly, I have never really spent a lot of time watching either. So I had a lot of friends growing up that were obsessed with Seinfeld, and I just never got into it. Having said that, I did watch a couple of episodes in the past few years, and I think I finally kind of got it. Having said that, I've seen Schitt's Creek's memes all over the internet, and I always laugh, and I'm always like, who is this and what show is this? And so I think I need to spend some time watching them. But yeah, I say neither, not because I don't think either of them are good, but because I'm just not an authority on the topic.
Well, this is perfect then, because I'm going to set you up for a live reaction perhaps to, these are both comedies, obviously, but both of these scenes here are representative, I think, of what the general public has an understanding of business expenses and corporate taxes and the idea of a write-off. So anyways, I'll let Eugene and Dan Levy here take it away.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people. What? Why are we having this conversation?
So if I need booze to get through my day, I can just write that off?
That's a stretch.
But the skincare products you got this morning, those are a write-off.
What skincare products? You purchased skincare products?
Okay. I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This? Not a write-off.
Oh, well, the betting's non-refundable, so...
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Well, then I'll return some things.
Okay, give me your reaction. Have you heard anything like this before?
Yeah, I mean, they're right, of course. And even my dad was a small business owner as well. He owned a tile store called Richmond Tile Center, rather. And when I was growing up, I actually thought the same thing. Like naive. Now, granted, I was 14 or 15 or whatever. But when my dad talked about write-offs, I effectively thought that meant they were free. And I didn't understand money or tax or even simple things like interest rates back then. But I thought the same thing. And it is quite common for people to think that a write-off is somehow some massive tax benefit. And it is a tax benefit, but at the end of the day, you still have to spend the money, right? So if you're running a business and you need to pay for some sort of service, then you can deduct that from the company's income, but you still have to spend the money, right? So all a tax write-off means is you're effectively not paying tax on that expense, but it's still coming out of your pocket. And I've seen people create small businesses with the intention of losing money in order to generate these tax write-offs, not realizing that they could have just used an RSP to reduce their personal taxes and not had to actually throw the money out the window, right?
Oh, that's crazy. Yeah, it's, you talk about the small business rate and they're largely the same in most provinces. And so if your corporation is buying, let's say, skincare or bedding or a lamp for business purposes, like Dan Levy is in the show there, then you're only saving the 11%. You're not saving the total cost of the product. You're not getting some sort of reimbursement for the total cost.
Yeah, that's exactly. And a lot of these items people think they can write off are not actually direct write-offs. They're capital expenses, right? And a capital expense is something that you write off over time. So the initial upfront benefit is that you can't necessarily write off the entire cost of something. You can write off a portion of it every year through a mechanism called the capital cost allowance, which is probably more than we need to get into, I'm guessing, on today's episode. But just as a quick aside, I had a client recently who came in and he bought $20,000 worth of camera equipment because he wanted to start a small business to lose money because his day job was a very high income job. And his spouse thought this would be a great idea to reduce his taxable income, start a business to lose money. So he spent 20 grand on camera equipment thinking he could write off the entire amount, but these would likely be looked at as capital expenses. And so he couldn't write off the entire 20,000, only a portion of that every single year. And at the end of the day, now he's got a bunch of camera equipment that he doesn't know how to use. That $20,000 he could have just contributed to an RSP, for example, received a dollar for dollar deduction from his income, and have an asset that ideally is going to grow over time and that he can withdraw later on. So it is a common misconception. Most of my clients who are physicians have great accountants. So luckily I don't come across this type of mentality too much because they've got a good professional team, but obviously the idea is still out there.
Gotcha. Yeah, for sure. I'm going to set up this one more clip from Seinfeld because I found it and I love Seinfeld, but it's kind of along the same lines of what we saw in the other show there. But lots of people think that corporations have some sort of unfair advantage in this way, that they can kind of deduct all these different things, which we've talked about just isn't true. But here's Kramer's take.
So we're going to make the post office pay for my new stereo now?
It's a write-off for them.
How is it a write-off?
They just write it off.
Write it off what?
Jerry, all these big companies, they write off everything.
You don't even know what a write-off is.
Do you?
No, I don't.
But they do. And they're the ones writing it off.
Wish I had the last 20 seconds of my life back.
Well, sorry, I can't give you the last 20 seconds of your life back there, Mark, and listeners here. But yeah, my takeaway there is that a lot of people don't have a good understanding of how this stuff works. And so you mentioned working with a good accountant makes all the difference. So here was my accountant, for example, one of them, I went out for lunch with him, and we were just cracking this joke, actually, when we went out for lunch. It wasn't a fancy lunch or anything like that, and we were fighting over who was going to pay, and he's, oh, it's a write-off, and so his accountant brain kicked in, and he said, I think I could negotiate a better discount with the waitress than I could for the tax benefits of this write-off for this meal right now. It's the benefits for many write-offs, including meals, they're only 50% of the cost too. So like there's all sorts of things where people think that you can steak dinners and champagne and whatever. It's like, no, it's not, just simply not true. That's just not really how it works.
Yeah. It's not free money, folks.
Yeah. Okay. Speaking of free money, what's the idea about passive income inside a corporation? So we talked about that. I know there's just kind of a cultural phenomenon around anything passive, because passive sounds like money for free. But when you have a corporation, define what passive income is in light of a corporation versus personal investing.
Right. So we talked a little bit about that small business limit, that 11% on the first $500,000. And I didn't clarify, but that's on active business income, right? So that's on income that your company earns doing the thing that the company does to make money.
Doing
right?
boat tours.
So our pizzeria, that's selling pizzas, right? But I also mentioned that you can retain money in the company if you don't need it. So in that example, we had a few $100,000 in profits left over that can stay in the company. And that can be reinvested in the business. But assuming we don't need that, we might move that to our own personal holding companies, for example, and invest it in a portfolio of global stocks or real estate or index funds or whatever that is. And any income that produces, so if we put a couple $100,000 into a global index portfolio and it's spitting out dividends and interest and this type of thing, that secondary income is considered passive income for the purposes of taxation. And so any investment income that you've earned on your retained earnings is not active income, it's passive income. And passive income is treated completely different. It's very complex, probably too complex. And it can be punitive if it's not dealt with well, or if the portfolio is not set up well, and if certain things like your compensation structure aren't set up correctly. So again, it's complex, so bear with me. So if you have, let's just say for the sake of this example, that you have some interest that you've earned. So you've taken your retained earnings, you put into it, GIC, and you've got $10,000 of income, investment income in the form of interest. There's no marginal tax rates for a corporation on any income really, but on passive income specifically. So you and I, if we earn that interest income, it would go on our personal tax returns and we would pay tax at our marginal rate. But a corporation does not have marginal tax rates. So that $10,000 is taxed at the highest level, which again differs provincially, but we'll call it 50%. It's a high tax rate. It approximates the highest personal marginal tax bracket. The interest is taxed very heavily, but there's a mechanism in place called refundable tax, and it was recently updated, where the government's going to essentially take some of that tax money and it's going to withhold it. And it's going to pay it back to you only when you pay yourself dividends personally out of your corporation. And the reason for this is obviously integration, but also to prevent people or dissuade people from just setting up holding companies and corporations for their personal investment portfolio, right? If I got an inheritance or won the lottery and I had a bunch of money, I shouldn't have a tax advantage by creating a company for myself, moving that money into the company and then investing it. There shouldn't be an advantage there. And so what the government does is they hold back some of the tax on that interest payment, and they will refund it to me when I pay dividends. So if we want to get a little bit into the numbers, we pay 50% tax on that interest, but actually 30.67% of that is refundable tax. So only around 20% of the tax we paid is actually permanent, irrecoverable tax. The other 30% is refundable. And when I pay myself a dividend personally, I get 38% back of my refundable tax. So if I have a refundable tax balance of, let's say, $38,000, if I pay myself a $100,000 dividend, the government's going to give me back that withholding tax, right? So again, it's a way to kind of prevent people from benefiting from corporations purely for investment purposes. Other types of income, like the taxable half of the capital gain, is treated the same way. So if you have a capital gain in your corporation, let's say you bought a stock for $1 and you sold it for $2, you've got $1 capital gain, only half of that is taxable, which is the same if we earn a capital gain personally, right? The half that's taxable is treated the exact same way as interest, right? So there's a withholding tax on it. It's taxed very heavily. The half that is not taxable credits an account called the capital dividend account. And this is an account that your accountant should be keeping track of. It'll be on your tax returns, your corporate tax returns. But effectively, the tax-free half of a capital gain can come out to you tax-free. The taxable portion is treated under this passive income regime. And then the other types of income, you've got Canadian dividends. So if you have a portfolio of Canadian stocks and they pay Canadian dividends, they're taxed or treated completely differently again. The entire amount of tax you pay is refundable tax. So basically, if you earn $1 dividend, you're going to pay about 38% in tax in your corporation. But when you pay out that dividend, the whole amount of tax is refundable. So in a way, Canadian dividends can kind of flow through a corporation without attracting tax at the corporate level. And then lastly, you've got foreign dividends, which are quite punitive. And that's because there's a foreign withholding tax. And that tax reduces the refundable tax that you get. So not knowing how passive investment income is taxed in your corporation can lead people to set up portfolios that are not very tax efficient. If you're not paying dividends out to yourself, then you're not getting the refund back from the government. So a lot of the tax that you're paying on that investment income kind of gets trapped in the government's hands. It's effectively an interest-free loan to the government. So you need to work with an accountant to kind of pay yourself enough dividends to be recovering some of that refundable tax as well.
Mark, one of the big takeaways that I've got so far is that maybe working with a professional is valuable if you're an incorporated person. Would you stand behind that assertion?
Yeah, absolutely. I mean, you probably need, to set up a corporation, you should be using a lawyer, because even just coming up with the share structure that is most appropriate for you in your business, that by itself is complex. And if you don't have a deep understanding of corporate share structures, then you're likely to make mistakes. I've seen people do it. I've seen them set up their own companies and cause themselves large tax headaches down the road as a result. So you very likely need a good lawyer. You definitely need a good accountant for some of the reasons that we just talked about, all of the differences between personal tax, corporate tax, passive tax. You very likely need a good financial advisor if you're not a do-it-yourselfer and don't understand some of the implications of setting up corporate investment portfolios. A good advisor can help. I think a lot of your listeners are probably do-it-yourselfers, and there's nothing wrong with that. But at the same time, some investment advice, whether self-sourced or hired out, is probably worthwhile. So if you've got those kind of 3 professionals on your team, you're much more likely to have a successful outcome.
So back to one of my first questions there, and you've kind of mentioned it a little bit, but maybe more specifically, if somebody has a small business, do they need to be incorporated? Or if they're a doctor, do they need to be incorporated? So what are those situations where someone maybe should or should not think about incorporating themselves?
Yeah. So doctors, for example, and other professionals, they can incorporate their practices, right? So doctors, dentists, veterinarians, naturopaths, physiotherapists, engineers, lawyers, accountants, they can incorporate as professional corporations. The difference between a sort of standard operating company and a professional corporation is that any activities that are directly related to their profession, they're not going to get liability protection for, right? So we talked about the benefits of, my friend's boat tour company having that liability protection. A physician, for example, doesn't have a level of liability protection for things related to practicing medicine, right? So malpractice, for example, they can be sued straight through to their personal assets, effectively. The corporation doesn't provide that sort of layer of protection. And so they need things like malpractice insurance, right? So for professionals, really the benefits come down solely to tax, right? And a lot of professionals aren't able to sell their practice. It's mostly a service business. I've got a number of clients who are emergency physicians, for example, or hospitalists, or they work in the hospital. They don't have equipment. They don't necessarily have staff that they're employing. The corporation really is just a tax mechanism to defer tax into the future, right? For non-professionals, I think the way to look at a corporation is first and foremost, is the liability protection important? So again, with my friend's boat company, right out of the gates, he incorporated it before he had a single paying customer, because the liability protection by itself was the impetus for incorporating. Sure, hopes it's really successful and you can retain a bunch of money and get all those tax benefits, but the liability protection itself was hugely important. The other thing is, if you've got a number of different people that you're involved in the business with, if there's 6 of you starting I don't know, a mining company or something like that, having distinct shareholder and a distinct corporate structure can make the business easier to distribute, to sell, to pass through an estate, for example, because it's kind of already chopped up for you in advance. Whereas if you had a bunch of people trying to get together to start a company under a partnership model, that might be a little bit more complicated. So there are benefits to dividing up a business. And then lastly, if the business is successful enough that you don't need all of the profits that the company generates to pay your bills, and you can defer and retain money in the corporation, then you can start to avail yourself of all of those tax benefits. So like a lot of financial planning, it's very situational, very specific. Whether somebody should or shouldn't incorporate comes down sort of to the facts of their circumstances. But working again with a good accountant and a good lawyer to kind of model some of these things for you can at least help frame that decision.
For sure. For a lot of people that are maybe trying to start their own thing, get their side hustle going, like they've got a 9 to 5 and then they're doing a thing on the side. Just like every kid probably starts off mowing lawns and shoveling snow and all that kind of stuff. Just because you have a business or it's something that you do on the side to make money does not mean you need to be incorporated by any means. It is at the point where you're earning pretty substantial income and needing to withhold or like not spend a significant portion of it because there's costs associated with having a corporation, setting it up, maintaining it, just the accountant bills every year. Yeah. They'd make you squirm a little bit for a lot of people just to keep something going. Yeah.
Well, and especially with the ongoing tax returns, right? Like a lot of people who are comfortable doing their own personal tax returns would not necessarily be comfortable filing a tax return for a corporation. They're far more complex. There's a lot more moving parts. Your accounting bill will go up substantially when you have a corporation. A lot of my clients pay between $3,000 and $5,000 a year just for filing taxes through their accountants, right? And I'm sure there's cheaper and I'm sure there's more expensive, but those accounting costs in and of themselves are expensive. So you need to be retaining a significant amount of money in order to justify the tax benefits after considering all of those costs. And it does add a layer of complexity that a lot of people just might not be comfortable with. So if you're not retaining a lot of money, sure, there may be some tax benefits, but the added complexity for some is just maybe not something they're prepared to deal with yet. So, and you can always incorporate later, right? Like the decision, it's not a one-time decision. You can incorporate your business later and roll your existing business assets into your new corporation. So there's a lot of flexibility around the timing of incorporation. Yeah, it's certainly not for everybody.
Let's talk about maybe someone that could be a hypothetical client of yours. Let's say they're high income earning doctor. They've set a professional corp. They've set that up. Now they need to live off something, right? So the professional corporation has earned money on their behalf, I guess, technically. And now you actually have to feed yourself and put a roof over your head and put gas in the car and everything like that. So how do you get money from the corporation to your pocket, regardless of the taxes and whatnot, but largely speaking, the two structures would be dividends and salary. Can you kind of walk me through some of the decisions you have to make in that regard?
Yeah, absolutely. So you're right. Those are the two main forms of compensation. Salary is deductible to the business and fully taxable to you, right? So let's go back to our pizzeria example for a minute. We earned $1 million in profits. That $1 million would be taxable to the business using the small business rate on the first 500,000 and then the general higher rate on the next 500,000. But if you paid yourself a $200,000 salary and I paid myself a $200,000 salary, that's $400,000 of salary that can be deducted, right? So now the company's profits are actually $600,000 instead of $400,000. So the company's going to pay less tax in that case. But our salaries to ourselves are fully taxable, just the same way as if we were an employee of any other organization, right? Because as shareholders who are working in the business, we are employees of our company. So salary fully deductible to the company, but fully taxable to you as an individual. And there are some other sort of nuances there, like any salary does require things like CPP contributions, Canadian Pension Plan contributions. The company has to contribute on behalf of the company, and you as an individual have to contribute. So there's sort of a dual payment of CPP, which is the same. I mean, if I'm an employee of McDonald's is contributing to CPP on my behalf when they pay me a salary. Basically, CPP is always paid twice, once by the company and once by the individual. It's just if you're an employee of a company, you only see your CPP contribution, but the company's contributing on your behalf as well.
And they get a deduction for it.
And they get, exactly. Yeah. And then the other thing is it generates RSP room. Right. So any employment income in the form of salary generates RSP room. As I'm sure many of your listeners know, it's 18% of your earned income which salary is usually the majority of that for most people, up to certain thresholds, right? The other form of compensation is dividends. And dividends really are unearned income. So they're kind of like investment income. And when you pay yourself dividends, the company does not get a deduction, right? So the company does pay tax on that money, and then you send it to yourself personally. But because the company has already paid tax, it's not necessarily fully taxable to you as an individual. It's complex, but the dividend that you pay yourself is grossed up first. That goes on your tax return, and then a dividend tax credit is applied to the taxes owing on that dividend, and it reduces the amount of tax you have to pay. The net effect is that because of integration, you're effectively going to pay more or less the same tax rate, right? There are interprovincial differences. In some provinces, there's a slight advantage to paying a dividend or a slight advantage to paying a salary. It's not usually enough to be the core reason you would want to make that type of decision. Tax rates change all the time as well. So paying dividend today might be slightly more tax effective, and then new provincial tax rates come in and upend that. So I think the main thing is that with dividends, you don't get any RSP room and you're not contributing to CPP. And a lot of business owners like that. They think CPP is a bad return on their money. I don't agree. I love CPP.
You're among friends here. Yeah.
Okay, good. I think CPP is wonderful for many, many people. It's an indexed pension for life. You can defer it, as your listeners know, and the amount just goes up. There's survivor benefits. There's some disability benefits in there as well. It's a forced savings plan for a lot of people. And I don't think the returns that you earn on your CPP contributions really should be the lens from which you make that decision. Because the other thing is a lot of people who pay themselves dividends don't necessarily save what they would have contributed to CPP and invest it. They should, but they don't always do that. I have clients who are on full dividend compensation models. And again, they have no RSP room, they have no CPP. So they're really driving their own ship. And what also happens is because you have no RSP room, because you have no CPP, you have a lack of diversity in sources of income in retirement, because now really the only thing you have is your corporation. Your holding company becomes your entire nest egg. And there's a lot of tax risk there, in my opinion. I mean, we've seen the government come after small businesses in the past and implement tax changes. If you've got all of your money in that corporation, you're opening yourself up to a lot of concentration risk. And I would much rather see people diversify that risk away by using CPP, by using RSPs, by paying themselves salary. So, and for a lot of people, their accountant is going to be the main driver behind that decision. There isn't really a right or wrong answer. There's certainly preferences, and some accountants are on either side of that debate.
And one thing to point out too is that a lot of people will end up having a combination of the two.
Yeah, absolutely. Yeah. So it's not all or one, right? So a lot of people, to your point, will pay a salary up to a certain level in order to gain those CPP benefits, in order to gain that RSP contribution room, and then pay themselves dividends on top of that. So yeah, kind of a hybrid approach is often most ideal for a lot of people.
Right, because the contribution limits for CPP are based off of something called the yearly maximum pensionable earnings, or YMPE. I think I've thrown that acronym out there for listeners before. We got too many acronyms in our business, but that amount is what this year? Is it mid 60,000s, I think?
Yeah, and it's going, well, there's actually an additional YMPE now because of the new enhanced CPP. Right. So I'm not sure how much digging you've done on that, but with the changes to CPP, now there's the regular YMPE, which I don't have the figure off the top of my head, but you're right. I think it's north of 60,000. And then there's another bracket now called the additional YMPE, through which you contribute a lower than you do on that first 66,000. And that's going to enhance your CPP down the road. So yeah, CPP is a bit of a moving target. And because the YMPE is indexed to, I believe it's wage inflation, the number just kind of keeps going up. So it's different each year. So your salary, if your aim is to max out your CPP and your RSP, your salary will be sort of on an increasing scale over time in order to generate the room to do that.
Okay, so we've talked about holding some money back, potentially investing, but there's some tax limitations on keeping people from investing a whole lot into their corporation, but at some level it might make sense to do that. So what are some considerations that people should have when it comes to investing in the corporation, keeping in mind all the little tax differences there?
Yeah, so one thing that was introduced somewhat recently, I want to say it was 2018 now, is something that I sort of jokingly call the PIG, the passive income grind. That's certainly not its official term.
This is a Mark McGrath original. This was perfect.
Yeah, I hope so, because I was really excited when I realized that the acronym was PIG. I was writing sort of a Twitter thread actually on the topic. And as I was writing, it just kind of jumped out of the page that the acronym was PIG. And I was like, this is great. I'm going to reframe this as like fighting the pig or wrestling the pig or whatever I said. But yeah, it's an interesting application of the rules. And so the PIG, the passive income grind, is a way to sort of punish small business owners who have too much investment income in their company, right? And so the way this works is that we talked about the small business deduction, that $500,000 threshold under which you pay a very low rate of tax. But what they've done is, if your company or your group of companies, so if you've got multiple corporations and you're the controlling shareholder, those companies are associated, is the official term, and associated companies are looked at as kind of one company for the sake of this test. So if you've got too much investment income, what happens is they start to grind down that $500,000 limit to a lower amount. And effectively the way it works is if you have more than $50,000 of net investment income, you start to lose $5 of your small business threshold for every dollar of additional income, right? So if you've got $150,000 of passive income, what happens is that whole small business limit goes from $500,000 to zero. And every dollar that your corporation earns is then taxed at the general rate of 27%. Now, this isn't the end of the world, because again, if you're paying yourself dividends out of that 27% pool of money, which is known as the general rate income pool, or GRIP, another acronym, you get an eligible dividend, which, as we've discussed, is taxed a little bit lower. It's just that if you're not paying yourself dividends, you're now paying 27% on your earnings. Again, these are BC tax rates. You're now paying 27% on your corporate money instead of 11%. So it is kind of punitive. The more passive income you have, the more you run into this issue. It's not usually a problem until you've got a couple million in corporate earnings. Like if you just look at current interest rates and dividend yields, the amount of income that your portfolio spits out isn't probably going to generate a grind on that threshold until you've got a couple $1 million. But for a lot of my clients and for a lot of small business owners, they've got that and more. And it's important to be aware of. There's a couple ways you can structure your way out of it. We talked about capital gains, which are a little bit more tax efficient because only half of your capital gain is taxed. The other half can be paid out tax-free. So having a portfolio that generates more in capital gains and less in foreign dividends and interest, for example, just means you've got that much more room before this is going to be a problem. You can do things like buy corporately owned insurance policies. Generally speaking, you should have a need for insurance before you look at something like this. You can open individual pension plans, IPPs, which are they're kind of called supersized RSPs. But these are kind of ways to shift money out of your corporation so that you've got less money there generating a passive income. So it's not the end of the world. People get really hung up on trying to limit their passive income grind. It's at the end of the day, like I said, you're probably going to pay the same amount of tax one way or the other. You just lose some of that tax deferral.
Right. So the government is trying to get in the way of any advantages one way or another.
Yeah.
So hopefully we've dispelled a few myths here of, investing in a corporation or having a corporation being some sort of tax cheating mechanism, some way to skirt around the rules and keep more money for yourself. In many cases, especially with some of these very recent rules, it can be the opposite, especially if you set things up the wrong way. And so for many people, incorporating doesn't really make a ton of sense necessarily. So for small business owners, maybe take a look at that liability portion. If you're in a business that has the potential, maybe you're running a boat tour in Whitewater Rapids or whatever. Boat tours here in Saskatchewan, we don't have nearly as many rapids out here. Or boats for that matter. Anyways. Maybe take a look at that instead of just taking a look at, I'd like to start my own business. I should get a corporation started. There's a lot of complexity involved here, but also a lot of opportunity to do things well if you're working with a professional financial planner or an accountant, and hopefully a combination of the two, along with a good legal team.
Exactly. Yeah. I mean, when done correctly, there can be massive benefits to incorporation. I don't want to downplay the benefits because they absolutely exist. Corporations have been around for hundreds of years for a reason, right? But it shouldn't be the first thing you look to necessarily. Just because you have a small business, as you pointed out, doesn't mean you need a corporation. You should chat with professionals to see, or to sort of model your circumstances and see if it makes sense. And if it doesn't make sense now, it may make sense down the road. So yeah, use a corporation when it makes sense. Have a good professional team. And I think that's all I got.
Cool. And finally, try not to listen to TikTok or YouTube or Instagram advice about corporations.
Although I am on YouTube, so you can listen to me about it on YouTube.
Listen to Mark on YouTube. There's a lot of noise out there that largely is inaccurate or is inaccurate for another jurisdiction. So there's a lot of American type of advice that I've seen on there anyways. Maybe I'm just like a magnet for like bad financial advice because I don't know what the algorithm is feeding me, but like all sorts of stuff about like buying vehicles and writing it all off. And it's like you're getting a free truck and it's like, come on, that's just not how it works here. So anyways, just be aware of what you're paying attention to in that regard. But Mark, I appreciate you taking the time to school us on this kind of thing. You live in this world, so this was really helpful for me and hopefully for our listeners as well. And if people would like to connect with you, what's the best way to find you?
Yeah. Thanks, Evan. No, it was a pleasure being here. I had a lot of fun, and hopefully your listeners took something away from it. If you want to get in touch with me, I'm very active on Twitter and on LinkedIn. My handle in both places is at Mark McGrath CFP. Folks can email me as well. But yeah, find me on social media or just shoot me an email. I'm happy to chat with anybody.
The CFP part is critical because I don't think you're the same Mark McGrath from Sugar Ray. Is that right?
I'm not. Interestingly enough, somebody, was it last week or the week before, an artist overseas did like one of those sort of sped up fast animations where they drew Mark McGrath from Sugar Ray really quickly, and they were really good, but they tagged me in it.
Oh, hilarious.
And yeah, it was kind of funny. So I wrote back, I was like, wow, you're a great artist. That was really impressive. But I'm a decent guitar player, but I'm absolutely not the same Mark McGrath from Sugar Ray. So unfortunately I can't buy the domain markmcgrath.com because he owns it and it just redirects to the Sugar Ray website. But one day I'll get that.
Awesome. Well, thanks so much for joining me, Mark. I appreciate it.
Yeah, likewise. Thanks, Evan.
Thanks for listening to this episode of the Canadian Money Roadmap podcast. Any rates of return or investments discussed are historical or hypothetical and are intended to be used for educational purposes only. You should always consult with your financial, legal, and tax advisors before making changes to your financial plan. Evan Neufeld is a certified financial planner and registered investment fund advisor. Mutual funds and ETFs are provided by Sterling Mutuals, Inc.